All right, welcome back, everyone, to another month of For What It's Worth. Jeff and I are back here to chat again about markets. Last time we were together in March, we were already getting through quite a bit, but gosh, a lot has happened since then. There's no doubt about that, right, Jeff?
Every day is a new day around here. There's no questions about it.
There's no shortage of reading. That is for
No,
certain, right?
not at all.
So, I think we got a pretty interesting topic. And actually, we talked about this last summer. We talked about debt and we were trying to put some context around national debt last summer. So this is interesting. Almost a year later, and we're back to a similar topic, but obviously talking more about what it is that I would say the market cares about so much with national debt. So just to kind of get us going here, I thought it was interesting. I just did a simple Google search of bond market. Literally, that's it, bond market. And I started to scroll through the news headlines. And to say it's not inspiring is, I'd say, putting it lightly, maybe. I don't know. Most recently, if anybody tries that, most recently, Jamie Dimon, I think this weekend, Jeff, made some pretty significant comments around this. And I mean, he's been around the block for quite a while, going back to the Bank One days. He's, a prolific banking CEO. So a lot of people respect his opinion. But as I think he said it, it's like, hey, look, JP Morgan's going to be fine, but maybe there's going to be some problems elsewhere, right? So I think that kind of sets the table for some of our conversation is what do we really need to be worried about? Like, what's all this conversation about the bond market? There is so much conversation about interest rates in the bond market. So what is it that we should be aware of, right? And how is this going to impact the economy or all of us? And, Jeff, I know you've got a ton of, history lessons for us here. So I'm going to turn it over to you and start to chat a little bit about this. And then I'll be back to wrap up some stuff, more specific impacts to the markets and whatnot as we chat here today.
Yeah, it's interesting, Ben. Jamie dropped that bomb on us all late Friday, and it was very interesting. His comment is, I don't know if it's going to be 6 months. I don't know if it's going to be 6 years from now, but the strain that the markets are under, the debt markets are under, we're getting to the breaking point. And it was interesting as, Scott Bessent was making the rounds this weekend on the talk shows, and he was asked specifically about the Jamie Dimon question. And he said, I've known Jamie for a long time, and, more or less, Jamie's always kind of talking like this. And I would say, no, Jamie's been around a lot longer than Scott Bessent. I think he has a little bit more insights. Definitely, I think Jamie is right. And there's a lot of other people that are echoing what he's saying. And you and I have talked about this, and we've talked about it with clients. I mean, I think the the best quote I can always give is Ernest Hemingway when he was asked about, how did you go bankrupt? And he said, well, it started off slowly, and then it happened really fast. And I think, that's kind of where we're at. And even Bessent this weekend said, hey, we're on the warning track. We're not going to hit the wall. We're not going to declare bankrupt. And I would have to say that I agree with him. I don't think the government's going to declare bankruptcy. I think it's very hard to ignore where we are at right now, just in terms of any way we want to look at this, whether it's debt to GDP, whether it's, interest payments for revenue that's coming into the government, whether it is the interest cost as a percentage of GDP, all of these things, we are hitting record numbers. And, I'm going to pull up some of this. And so we have real specifics. But the reality is we are at a very bad place. And now we're going into the summer with a potential extension of the TCJ, as well as adding on top of it additional tax cuts. And, quite frankly, a lot of people are just saying, this is reckless. How can we do this? Because it is definitely going to add to the debt. It's going to blow a pretty big hole in the deficit. And while there's a lot of things that are being talked about, whether it's tariff revenues coming in to help offset some of this, whether it's increased growth in the economy, which will increase tax revenues, we'll talk a little bit about all those things. But, the reality is that I think it's going to be hard to go through with this big, beautiful bill and not have some blowback. And we're already starting to see that, as you pointed out to begin with the bond market. And that's what it's going to be.
It reminds me a lot, Jeff, right? And I know you're going to keep going with this. I don't mean to interrupt, but it reminds me a lot of was it October of 22? Yeah, it's October. Over in Europe, right?
Oh, yeah, the Liz Truss moment.
Yeah. I mean, it feels like the same thing. It's like we can do no wrong. We can do and say whatever we want to say until all of a sudden the market has something to say about it. And that didn't end well, right?
And the funny thing is we got to add a little humor into this because why wouldn't we? But there's a couple of new acronyms that have been floating around. One is it related to October of 22, which was called the moron premium, and how they assigned that was basically the jump in yields because of the stupidity of what Liz Truss was doing. And granted, she lasts 45 days and she was
Yeah.
gone, but, we don't want to have to think that that's going to be assigned to the United States in addition to the taco trade that kind of, erupted last week. But, there are things that we've learned from the past, and we'll talk a little bit about 1990s, because I think that is a wonderful example of how we got out of a mess
Yeah.
and what could happen and what it could look like. But ultimately, we've got to get this addressed and have an adult conversation. But to put things in perspective, let me just kind of go over kind of just some data points so that clients understand what we're talking about. And I'm going to get a little, historical here, and I'm going to get a little technical, so bear with me. But, our current government debt right now is $34.5 trillion. And that as a percentage of our GDP, which basically is, if the government was a corporation, GDP is basically all of their sales. And GDP is roughly 28 trillion. So our debt to GDP right now stands at about 123%. And that's not an enviable number. I want to put that out. When we look at just from a historical standpoint, our peak was right after World War II. It's very important to understand we were coming out of a world war. We haven't had a world war. We've actually had really good economic times the last 25 years. And, quite frankly, outside of COVID, really low unemployment. So we should not be at where we are right now. And interestingly enough, Ben, in 2000, we were at 55%. So, basically, our debt at that point was not that bad. And so it just took us 25 years. That's all pretty much, through both political parties. There's not one that is, quite frankly, you can't say it was Republicans, can't say it's the Democrats, it's both of them to basically get to this point. And, if we move beyond that debt and we look at our deficit, total deficit currently for 2025 is about 1.1 trillion. We're expected to reach about 1.9 trillion at the end of the year. And that's if the Tax Cuts and Jobs Act expired and no new spending came in, which we know is not going to happen. So that's about 6.2% of our GDP. And remember, when you've got a deficit, you're spending more money than you're making. And, while this number is not the highest in terms of history, it's definitely trending in the wrong direction. There's no questions about it. Again, the last time we had a surplus was in 2001, which was about $128 billion. So we went from $128 billion of a surplus to now we're looking at about a 1.9 trillion deficit by the end of the year.
Yeah.
Again, not a great place to be. Some of the other things that I think, have got us a little bit worried more so than some of those other numbers is just the interest we pay on our debt. And currently it's about 973 billion a year. To kind of put that in perspective, that's more than what we spend on defense and Medicaid combined. And, as a percentage of our revenue, it'll be about 18.4% by the end of this year. And, we're expected to reach about 22.2% by the end of
And I
2035.
and I think there's a lot of things that are concerning that have gradually been building for many, many years. But I think that's got to be top priority for one of the
Absolutely.
most alarming ones is what it takes just to service our debt.
Yeah.
I think of what could get a company in trouble. And we oftentimes talk about something called their debt to income ratio, right? Or debt servicing ratio. When that starts to climb, that's oftentimes an early sign of, wow, this company is really in trouble.
Yep.
And like you said earlier, like at first, that's just kind of this slow build, and they're trying to climb their way out, or maybe they're just trying to tread water, let's say. But as time goes, that debt servicing cost just really starts to swallow you up at some point.
And it escalates. It's
Yeah,
not like there's a slowdown because, I mean, if kind of like, if you're seen as a wounded animal, um, ultimately the problem is they're going to start circling more and more. And
yeah,
that's the bond market. And that bond market basically is going to start pushing up those rates. And it's important to understand the Federal Reserve does not have control of the treasury market on the long end or the intermediate term. All they control is that Fed funds rate. And so unless they want to enter back into quantitative easing, which no one really wants to get to, then it's the market forces that are going to dictate that. We're making some assumptions right now that we don't move too far off the mark, of a 4.5% 10-year treasury or a 5% 30-year treasury. And we're already starting to see the Bank of Japan have problems with some of these longer dated maturities in their auctions. And there's deep concern that that's going to happen to the US. And so again, how are we going to fund this debt?
Mm-hmm.
And if those rates keep going up, then that interest servicing cost keeps going up. So to say that clearly we are concerned, with this and with this act that they're talking about passing or extending, Jamie's right. It could be 6 months, it could be 6 years, but the debt burden that we are under right now is going to crack.
Yeah.
And, interestingly enough, Ben, you and I were talking a little bit about this where, okay, when was the last time that we actually had tax cuts that had a meaningful impact on creating growth, that created higher tax revenues, that were able to pay down the debt or the deficit? Interestingly enough, it was the Kennedy administration when they put in a tax cut, but we had a completely different economy back then. We were growing at about 5% a year.
Yeah.
We struggle to grow at 3% a year right now. So we haven't had, frankly, good experience with tax cuts paying down the deficit or the debt because we've had higher economic growth. That's just something that, frankly, unfortunately, just generally doesn't work.
Yeah.
So
because really there's two sides to this conversation, right? It's either you're going to generate more tax revenue
Yep.
to help cover more, or you got to slow down your spending. There's not
Correct.
much more to it, right?
Correct. And, Doge got kicked off this year,
Right.
grand ambition.
With a lot of high hopes.
$2 trillion in cuts.
Yeah.
And, the Financial Times did a pretty exhaustive accounting of so far what they've been able to squeeze out. And we are talking $35 billion. That's it.
Yeah.
And already the government expenses for the first quarter of this year are higher than last year. So where are we going to get those cuts? I mean, it's hard to squeeze the cuts unless you really want to start tapping into things like Medicare, Medicaid, Veterans Affairs, things like that.
And because I think that's what we addressed last year on this talk during the summer, Jeff, was like the reality of the conversation is like 75% of our budget is like fixed expenses.
Yep.
There's 25% that I would say like they could work on cleaning up, but the vast majority of our expenses, not only are they fixed, like Medicare, Veterans Affairs, things you're saying, but most of those are also indexed to inflation.
Yes. Yeah.
So like regardless, it's going up year after year. Like Social Security payments, well, that's going up, right? We get cost of living adjustments.
Well, and again, this kind of comes back to the thing we always talk about. Nobody wants to have the adult conversation, right? Nobody wants
It's pretty unpopular.
Yeah,
right?
It is. You don't get elected. You don't get
No.
elected saying I'm going to raise your taxes.
No.
You cut your Medicare or your Medicaid. I mean,
that's me telling my kids we got to eat our broccoli or whatever tonight and not just ice cream for dinner. Not popular, man.
Well, and I tell you, it's funny when you talk about kids. When I was reading through this bill, looking at it, I kind of also thought about, Jackson. And it's like, when Jackson comes, we like to, candy him up. So as to say,
Sure. That's
then
fun.
send it back to mom and dad. And a lot of this bill is doing exactly that. You've got the front end loaded on the tax cuts, and then you don't have the cuts in the spending until almost 2028, which is the next presidential election. So it's kind of like we're going to have fun up until then, and then the pain is going to start.
Yeah.
And that's some of the problems. But let's talk about a period where we had success in tackling this. And I think this is very interesting because it was unpopular at the time. And it all starts with George H.W. Bush.
Mm-hmm.
Read my lips, no new taxes. You and I, we talked about this.
Oh, yeah.
Bush raised taxes. He was so unpopular there was not one Republican that voted for the tax increase, but it got passed and he lost the next election to Bill Clinton. Because again, kind of going back to what we say, you don't get elected when you're raising taxes. But he raised taxes because he saw where we were coming out of the 80s, that tax cuts didn't necessarily help the deficit or the debt. Actually, it exploded. Even though we had some economic growth, the expenses didn't get under control. And one of the things he passed in his bill was, yes, taxes went up, but it was also a pay as you go. If you increase spending, you had to pay for it. So that was part of the bill.
Which is what they're trying to do today, right?
Yeah, but the problem is that when you look at the actual numbers of what they're talking about, they're talking about literally this bill would lower projected spending by 1% and it would increase deficits close to 15%. That's a hard number to swallow. I mean, and that's from the Congressional Budget Office looking at this. So spending is huge. You've got to cut it and you've got to reduce it, and freeze it. So we had Bush. He increased taxes. He put the pay as you go in there.
Mm-hmm.
Lost the election. Clinton comes in. Clinton immediately passes another tax act in 1993, increased the rates on the higher end tax brackets. Then you had the 1996 Tax and Welfare Reform Act, which basically Clinton was forced into by the bond market again, into cutting welfare benefits,
Mm-hmm.
put more emphasis on the personal responsibility, kind of what they're talking about now, work requirements. But the reality is by the time we ended the 1990s, that combination of the tax hike first by Bush, then by Clinton, then the cuts by Clinton, left us in one of the best financial shapes that we've been in decades prior and decades since. So the reality is we know how to do it. It's just getting our politicians to do it.
And we've seen it actually happen. It's not even just about knowing, right? This is proven in history, right?
Yeah,
This worked. It
it
happened.
worked.
Someone did it.
And it'll work again.
Mm-hmm.
But I think that the only way we're going to get there is very much like Bush got there and Clinton got there, which is the bond market. We talk about the bond vigilantes, and the bond vigilantes collectively are just the bond market going on strike and saying, you no longer are credit worthy to get this interest rate. You're going to have to pay X, and it's going to be higher, and it's just going to keep pushing more and more and more pain on you. And we're starting to see that manifest itself. Every time we see that 10-year treasury at 450 or the 30-year at 5, we've had the Trump administration back off on some things. So it's out there. It's just a question of whether they are going to listen to it or whether it's going to come in and really kind of force that. But that's where we come to the market. Okay. If it seems like they are not going to do it on their own, and collectively, I mean, both parties are not going to do it on their own. So if they don't do it and the bond market does come in, let's talk about what that potentially happens to, obviously, the markets in our portfolios.
Yeah. Yeah, absolutely. And I would just start, I think, with two things that you've already kind of touched on some of this stuff here, Jeff, but I think it's important to identify two things. And one, you've said this to me many times. I've heard you share this when we're in meetings with families we work with many, many times. History doesn't repeat itself, but it often rhymes, right? And that's where I think everything we've talked about today, looking back at the past, looking at the 90s, looking back at the post-World War II era of when we hit a peak. And, we've come through a lot of these moments and we can use them as guideposts. But I think we have to be really careful about using that to try to predict the future as far as what's going to happen next. By no means we're trying to do that here today. We're just trying to say, what is it that we learned from the past and how can we maybe think about that and more or less prepare ourselves from a mindset? And some of it is positioning, right? But not getting overly aggressive and thinking that we can predict the future based on the past. I don't think that's appropriate, right? So then I think the other thing is that, again, you also kind of gave a nod to, which is, it's likely that a lot of things are going to move slowly. And then suddenly it's like the whole tariff situation that happened this year. How long are we talking about tariffs? And then it wasn't until that moment in April where boom, ripped the Band-Aid off and then it moved massively. But we had been talking about tariffs for months and the market really didn't care about it. Right. So again, I just say that to acknowledge the fact that A lot of things we're talking about, it's not like tomorrow all of a sudden we're going to see bond rates go through the roof, right? Who knows when this is exactly going to happen? And I think that's why it's really important to focus on what we can control and understand that there's no way we can predict this stuff, right?
Well, and I think that, you're right. And so much of, I think, what is being played up with passing this bill are things like the Doge cuts, the tariff revenues. And the reality is, we've already seen the numbers on the cuts are not adding up. The reality is probably the tariffs are not going to add up. We'll get some increased revenue with the tariffs. The Peterson Institute for International Economics did an incredibly in-depth analysis of the tariffs, both at a 10% versus 20 versus, higher. And the reality is you have a diminishing law of returns. The higher you go, the worse the situation gets in terms of revenue coming in. But even at best, with the tariffs, even at best, you're still at a juncture where the revenue is not going to come in and it's going to help. We're back to these things. We're hoping these things. Again, history doesn't repeat, it rhymes. We've got different things in play, but it's still going to be very difficult. And one of the things is in the 90s, a lot of our clients remember the 90s. They were not bad times.
No.
They were not bad. Taxes went up, cuts happened, and the financial markets did very, very well during that time frame because we were showing that we were on a path
Yeah.
to sustainability.
Which is interesting because I'm going to talk about that here in a second when we get off the bond market and talk about stocks and how we can, again, just keep in the right frame of mind for what we're going through and not just scaring ourselves out of sticking with the plan we have in place, which is kind of the long story here, right? Or the short story to the long conversation we're having. But, bonds, as far as rising rates, I think what's important to remember is during the transition, meaning rates going up, that can be a painful process. And 2022 showed us that. But with that being said, I would take away two things that we also learned on the back end of 2022. And it really depends on what your starting point is. So when we were starting at rock bottom rates and people were getting mortgages at like 2.75 for 30 years, going from that to moving to normal, it had such a distance, such a delta to get through that was going to be painful. We've worked through a lot of that. Do we have more that could go? For sure. I mean, I heard someone the other day say, the 90s, you had mortgages average in the sevens. The early 2000s, you had mortgages averaging in the sixes. All right. So today we're back to the sixes.
Yep.
That's not abnormal, right?
No.
And so again, we're starting to move our way back to normal. Maybe we overshoot the runway. That's very normal for financial markets. You would always call it the windshield wiper effect, right?
Oh,
you go from one extreme to the other, and we're most likely to move through that. The other thing that I would just point out about these rising interest rates, though, and this was talked about early in 22, and I think some people got mocked for this, but it actually played out, and it's still playing out. You hear these stories of like a Google or, an Apple or whatever, that they just have massive cash balances and the money they're making on their money markets. I mean, that funnels down to me, you, and everybody else, every retiree out there. You're getting a lot more income for your cash, or generating income in retirement is starting to become easier versus the last 2 decades that were extremely painful to try to generate income. Or you had to take more risk. There is a positive to this. It's just the transition period can be painful, and we have to be careful about how we navigate that transition, which is obviously what we're focusing on.
Yeah, and I think that, Ben, you made a really good point in terms of, a standpoint of, how in 2022, how aggressive rates moved up because we're so low. I mean, going back to it, I mean, the 10-year treasury was 0.68%. It was the lowest since the history of this country. 0.68 to 4.5 is one heck of a move. 4.5 to maybe 5 to 5.5 is not as big of a move, but it can have a huge impact on the government. But when it impacts our portfolios, that's not as big of a move. Or a 30-year from 5 to 7. Those aren't that big of moves, but it does have some pain during that correction phase. But there's also opportunity. Think about, our clients have literally been subsidizing borrowers for a long time.
Yep.
Now we're not subsidizing borrowers anymore.
Right.
Now,
Yeah. You're starting to get paid on cash.
absolutely.
Right? For the first time in a long time.
Yep.
So I think that's a big part of the conversation. It's just important to acknowledge this isn't all just terrible doom and gloom. Yes, we got stuff to work through, but it's not all terrible doom and gloom here. I think really, in my opinion, I think one of the more important things for us to watch to say, hey, maybe this stuff going on in the bond markets is going to start to make its way to, as we would call it, Main Street from Wall Street, right? Wall Street pain could be you're seeing rates rise and some people are struggling with the principal performance on their bond portfolio or something. Where that makes its way to Main Street is if we start to see defaults, right? It's credit stress, right? So is a borrower not able to make their payment? Now we've talked about the United States, but I'm going to translate this to, well, there's a lot of other pieces of the bond market, including corporations. I think here's where, the benefit here, which I'm going to talk about investing directly in the companies as well. We got to realize that the corporations here in the United States, I would even say kind of extending beyond that, the rest of the world, many of these corporations that we'd be involved with or have dollars either lending directly to via debt investments or owning via stock portfolios, these companies are extremely strong. They got great balance sheets. They got really good cash flow and income, right? All those kind of things are important to remember, that as much as we're talking about what's going on with the US government, I think those things are the items that I would be looking for, because ultimately, if you start to see these bankruptcies in corporations, what's that going to lead to? Job loss.
Yep.
Now consumers are losing income. This is when it starts to spiral and start to become a bigger thing. But if we can keep our corporations clean and they can stay in fairly good standing, this is where it's important that we don't see interest rates skyrocket, right?
Yep.
Because if the 10-year treasury goes from 4.5 to 5.5 to 6, that will, just the same as it's going to have a knock-on effect to the person going to get a mortgage to buy a house, it's going to have a knock-on effect to XYZ company borrowing money to build a new factory so they can employ more people. There's this absolute domino effect. I think that's something that for me is probably higher on the radar than watching where rates are moving, is what's happening with credit stress.
And that's
Good.
no, and to your point, this is one of the reasons why, we moved out of the small caps.
Mm-hmm.
Was simply because they need to borrow more money than a Google, as you were pointing out, or a large corporation. When their borrowing costs go up, obviously it impacts the revenue, impacts their stocks.
Yep. It's a lot harder for them to operate in an uneven market or a more stressed market, right? So it makes sense that we move away from companies that are going to be more challenged in this environment, right? I also think one other thing I just want to address and just touch on real briefly, because we've seen this a couple of times here lately, and I think it's something to keep in mind as we do start to see rates move, is kind of, again, watching what's the follow through. So when a few times here as of late, when you started to see interest rates move up, for example, during the initial conversation of tariffs, you saw rates move up. And what happened? They came in and said, hey, wait, we're going to put a pause on this whole tariff thing and we're going to work on negotiations, right? And then what happened? The markets calmed down and kind of relaxed a little bit. We saw a move up here just recently. Interest rates jumped pretty abruptly over a day or so. And then that weekend, Trump and his administration backed off and said, look, we're going to put a pause on this huge tariff on the EU. And Apple was in its sights of not producing iPhones here in the United States. And so every time we get there and the market reacts via higher interest rates, we see this administration saying, well, whoa, wait a minute here. Maybe we shouldn't do that. Right. So I would say there could be some positives of, it seems like what you've alluded to several times here today, Jeff, that the bond market can be a pretty mighty force to come up against. It seems like they're hearing it. And this is exactly how, not exactly, but it kind of rhymes with history, kind of what happened with Clinton and his administration. Things they didn't want to do, but they started to get forced into doing, right? So again, I think we're starting to move down maybe a similar path to that extent. So just to wrap this up, and kind of move on to the other part of the equation, away from the debt markets. When we move away from the debt markets, Jeff, you already mentioned it, higher rates will squeeze those companies that are not of the highest quality. So one of the things we're absolutely doing is making sure that we're in a position that the companies we have exposure to are going to be the higher quality companies with the good balance sheets, good cash flow. And quite frankly, and this was talked about a few years ago from one of our research partners at Strategas, they said, look, you want to focus on companies that they can be their own bank.
Yeah.
Right. They don't need to rely on the debt markets. Now, obviously, debt for a company that's growing and some leverage is good, especially for investors. That's how you're going to get a better return on your money, but not to their detriment. And I think that's what he was really alluding to, and not being, hamstrung to the fact that you have to rely on the debt markets, but rather for a time period, you could pay cash to acquire a business or pay cash for that factory, understanding that you could refinance that later when debt markets calm down. Right. So I would just say, based on, this one indicator, there are some US companies that are seen by investors that are less likely to default. I think this is, one of my last points that I would say is really interesting. And it speaks to the market's perception of what is going on out there. So there's something called credit default swaps. My plain English version of what a credit default swap is what are people paying, or what are their expectations for odds of that company defaulting? Right. And the higher that goes, the more likely they believe that that company could default, or in this case, the US government could default. And I'm not going to get this exactly right. I heard it in passing in some research that I was listening to. There's somewhere around 50 some companies here in the United States that have a better rating, let's just call it, via the cost of their credit default swaps, a better rating as far as less likely to default than the US government.
It's pretty shocking, isn't it?
That's shocking.
Yeah.
Right.
I mean,
But again, I think that speaks to the fact that, if you had concerns over this and you're really watching the US government debt, would you lend Apple or Microsoft $10,000 over the US government? There's some people that would absolutely believe so. Right. Yeah.
Look at their balance sheet.
Right.
I'd take
And that's
Microsoft.
And that's the commentary. And that's where oftentimes I will come back to this idea that the market will tell you a story. You just have to listen, and you got to learn to hear what they're saying. But again, it's us not trying to predict where these things are going, but rather listening to what the market is telling us. And I think that's what we're really trying to get across here today, Jeff, is we're not going to try to predict this stuff. We're learning from history, and we're listening closely to the market to say, what is it that you care about? Where should we be looking?
Yeah. And it's interesting because, even though we have talked a lot about this over the last 2 years, it finally seems like more people are talking about it.
Absolutely.
More people are bringing it to the forefront. I mean, you turn on, Bloomberg, you turn on CNBC, the news sources, some of the news sources we also listen to. It is constantly being talked about every single day. And it is going to be interesting to see how this plays out this summer, both with this bill as well as what the reaction is to the bill, coming from the bond market and the financial markets as a whole. And, and we have been blessed and fortunate that, the US dollar has been the world's reserve currency, literally since the end of World War II, where we took over from the pound sterling. But we can't take that for granted. And I think, we're at a point where things are pivoting. And I think the world is now starting to look at this and say, even the biggest of the big can get to the point where too big is too big. And I think we're there with the debt, with the deficit. And it's going to be interesting. I mean, we've prepared ourselves, our portfolios for this. I'm glad we have. But, the story's not done yet.
No, not even close. And this would just be my last comment. Then, Jeff, I'll leave it to you to wrap things up for us today. But, I think it's important to acknowledge that as time passes, markets are moving faster and faster than ever. But we can't believe that just because we're talking about this issue with bond markets today means tomorrow this is going to play out. I think it's going to, it's going to, when it decides to move, it'll move really fast. It'll be a bit of a waterfall type scenario.
It's there in Hemingway.
Right. But it can be there in the back of our minds for an extended time period with really no impact on the markets. And so I think that's where we continue to come back to this idea of we want to continue to remain focused on the things that we can control.
Absolutely. And, and I think that, we obviously don't want to be blindsided. We have these conversations. We don't want our clients to be blindsided. And, it is a deep topic and quite frankly, a lot of conflicting opinions, depending on what side you want to be on this topic. But I think, the important thing is I think we're finally at the point where it's starting to get addressed. And the 90s show us you can address this situation and make unpopular decisions, and the markets will benefit from it because, like anybody, if you show that you're moving in the right direction, you get rewarded for that. We have to start moving in the right direction, with some unpopular conversations that nobody wants to have, but they're going to happen.
Yep. Absolutely. All right. This is a little bit longer than our normal one, but obviously this is an important topic.
Very important.
maybe some more questions will come out of this. So please send us your questions. If there's some side topics of this that you would find interesting or want us to dig into, that's what we're here for. We're to help inform you, make sure that we're all on top of what's going on out there. So stay in touch, send us info. Please give us some thoughts of what we can move on to next if there's an important topic for you. But until next time, it was great talking today, Jeff. Thank you for all your input, bringing in the history. Thank you so much. And we look forward to chatting with you again here in a couple months.
Can we hope for a boring summer?
I would love to go on vacation and not be staring at my phone the entire time personally. Here's hoping.
Vacation.
Yeah, right. Here's hoping for it. Yeah, absolutely. Until next time, everyone have a great summer.
Be safe.
Bye now.
Bye-bye.